You're sitting at a kitchen table in a house that doesn't look like billionaire money. No marble, no gold fixtures, just a scuffed farmhouse table and a woman named Corinne Ashworth pouring coffee into a mug that says, "World's okayest grandma." Her family is worth just north of $1 billion, built off a string of self-storage facilities nobody thinks twice about driving past. And she's about to hand her 27-year-old grandson a piece of paper that will change how you think about money forever. It's not a check, it's a promissory note. $340,000, 6-year term, 8% interest, first payment due in 30 days. He's buying a house. She's the bank. Not the bank like a nice metaphor for a generous relative. The actual bank, structured, documented, interest-bearing, tracked in a spreadsheet that gets reviewed every quarter by a family office accountant who does nothing else for a living but manage internal loans like this one. Somewhere in that same spreadsheet is a loan to a niece for a dental practice build-out, a loan to a cousin for a Series A bridge, a loan from 12 years ago that funded a divorce settlement, fully repaid, interest and all. This family stopped borrowing from banks decades ago. Not because they couldn't get approved. Obviously, they could get approved for anything. They stopped because they realized something most families never even consider. If you have enough money sitting around, you don't need Chase or Wells Fargo to lend it out and collect the interest. You can be the one collecting the interest on your own money, lent to your own kids. That's the whole idea sitting underneath everything you're about to learn. A family bank isn't a place. It's not a vault in someone's basement. It's a system, a set of rules the family agrees to follow, where instead of money moving from parent to child as a gift, no strings, gone forever, it moves as a loan. Documented, interest-bearing, expected back. And here's the part that trips people up every single time they hear it for the first time. Why would you charge your own kid interest? Isn't that what makes family money feel cold, transactional, like something out of a corporate boardroom instead of a living room? Corinne would tell you the opposite is true. A gift disappears. It gets spent, it gets absorbed, and 6 months later, nobody remembers where it went or what it was for. A loan, on the other hand, comes with a number attached to it, a due date, a reason someone has to explain out loud before the money moves. That structure is the entire point. It's not about squeezing family for profit. It's about making sure the money that leaves the family bank eventually comes back to it so it can go out again to the next person who needs it. A gift is a one-way door, a loan is a revolving one. And that number 8% isn't random. It's not Corinne picking a figure that felt fair at dinner. It's tied to something called the Applicable Federal Rate, a number the IRS publishes every single month that sets the legal floor for what a family loan has to charge in interest if the family wants the IRS to treat it as a real loan instead of a disguised gift. Go below that floor, and the tax code stops seeing a loan at all. It sees a gift wearing a paperwork costume and it taxes it accordingly. Families with real money don't get to skip that step. They live inside it. The rate moves with the market, and right now, in this environment, something in the 7 to 9% range for a longer-term loan is common enough that 8% isn't an outlier. It's just where the math currently lands. You'll get the full mechanics later. For now, just sit with this. The interest rate isn't the family being cold. The interest rate is the family being legal, and legal is what makes the whole machine survive contact with the IRS. Now hold that up against how your family probably handles money. Your cousin needs $4,000 for a car repair. Your uncle floats it to him over a phone call. No paper, no date, no number attached, just a vague understanding that he'll pay it back when he can. 18 months later, nobody said a word about it out loud, but it's sitting in the middle of every holiday dinner like a piece of furniture nobody wants to move. Your uncle brings it up once, gets a defensive answer, and now there's a version of resentment in that family that will outlive the $4,000 by decades. That's not a bank. That's a wound with a receipt nobody kept. That's the difference. Informal family loans rot because there's no structure holding them accountable to anything, not to a date, not to a rate, not to a shared understanding both sides agreed to on paper. A real family bank removes the guessing. Everyone knows the terms before the money moves, so nobody has to reconstruct them from memory during an argument 2 Thanksgivings later. And here's the part that actually makes this worth an hour of your attention instead of 5 minutes. Once a family sets this up correctly, the money doesn't behave like normal family money anymore. It behaves like an engine. Every loan that goes out comes back with interest attached. That interest becomes capital the family bank can lend out again to the next kid, the next house, the next business idea that a real bank would have said no to. Corinne's family didn't get to $1 billion by getting lucky once. They got there partly because they built a system where the money keeps circulating instead of leaking out through gifts that vanish the moment they land. You're about to learn exactly how that system is built, piece by piece, starting with the part almost nobody outside a family office ever sees explained in plain English. So let's actually open the paperwork Corinne's grandson signed, because the mechanics matter more than the sentiment does. A promissory note isn't a handshake dressed up in a folder. It's a legal document, the same kind a bank would generate if he'd walked into a branch instead of a kitchen. It states the principal, $340,000. It states the term, 6 years. It states the interest rate, 8%, and it states exactly when payments are due, monthly, first one landing 30 days after signing. If he stops paying, the family has the same legal standing to call the loan that any lender would have. That's not paranoia. That's the entire mechanism that keeps this from collapsing into what happened with your cousin and the $4,000 car repair. Here's the number almost nobody outside a family office has ever heard of, and it's the number the entire system hinges on. Every single month, the IRS publishes something called the Applicable Federal Rate, the AFR. Think of it as the government's official answer to the question, what's the minimum interest rate that makes a loan between family members look like a real loan instead of a gift wearing a disguise? There are short-term rates for loans under 3 years, mid-term rates for 3 to 9 years, long-term rates for anything past that. Corinne's grandson has a 6-year note, so his loan gets measured against the mid-term AFR. As long as the family charges at or above that published floor, the IRS has no argument. Charge below it, even by accident, even because grandma felt generous that month, and the IRS is allowed to treat the difference between what should have been charged and what actually was charged as a gift. Which sounds harmless until you remember gifts have their own tax exposure once they cross certain thresholds every year. The AFR isn't a suggestion, it's the line between a loan and an audit. Now here's where 8% stops looking like an arbitrary number and starts looking like the smartest math in the room for both people at the table. From the grandson's side, 8% on a family loan can still beat what a bank would have offered him for the same $340,000, especially once you factor in what banks tack onto a mortgage that a family bank doesn't. No origination fee, no underwriting delay, no appraisal contingency killing the deal because a comparable house 3 streets over sold slightly low last month. No credit score determining whether he even qualifies. From Corinne's side, 8% sitting in a documented, interest-bearing loan to her own grandson is often outperforming what that same $340,000 would have earned parked in a conservative bond fund or a savings vehicle. She's not doing him a favor at a loss. She's redirecting capital from an external institution into her own family's balance sheet at a rate that beats what Wall Street would have paid her for the privilege of holding her money. Everybody wins except the bank that didn't get to touch this deal at all. But the part that actually protects this whole structure, the part that separates a real family bank from a well-meaning disaster waiting to happen at the next family reunion, is making sure the loan can never be reclassified as a gift after the fact. The IRS doesn't just look at the interest rate, it looks at whether the loan behaves like a loan. Is there a written note? Is there a real repayment schedule actually followed, not just drafted and ignored? Is interest actually being paid and reported on both sides on tax returns? Does the lender have any real intention or ability to enforce repayment if it stops? Families skip these steps constantly, tell themselves it's basically the same thing, hand over $200,000 with a verbal promise and a warm hug, and then get blindsided years later when an audit or an estate dispute forces someone to prove this was ever a loan at all. Without the paperwork, there is nothing to prove. It just becomes a gift, retroactively on someone else's terms, at the worst possible moment to discover that. This is exactly the part where most people, even smart people, even people with real money, get it wrong enough to cost themselves 5 or 6 figures in penalties, back taxes, or family litigation. If you're serious about setting one of these up, even at a much smaller scale than Corinne's billion, this is the one section of the process worth outsourcing your understanding of instead of guessing. The book this channel keeps coming back to, the one that actually walks through sample promissory note language, AFR tables, and the specific documentation the IRS wants to see before it'll respect a loan as a loan, is discounted this week, and honestly, at that price it's cheaper than 1 hour with the kind of estate attorney who normally explains this to you. Links below. It'll save you from learning this the expensive way. Once the structure is airtight, this is where family banks stop being a tax curiosity and start being genuinely useful in ways a real bank will never match. Home purchases, like the grandson's, are the obvious one, but it goes further. A niece gets $85,000 to build out a dental practice a commercial lender wouldn't touch for 2 more years of revenue history. A cousin gets a bridge loan against a Series A that closes 4 months later, repaid in full the week the funding lands. A grandchild's 4 years of tuition gets structured as a loan instead of a gift, interest accruing quietly while she's in school, repayment beginning the year after graduation, teaching her something about debt that a 529 plan never could. None of these are things a stranger at a bank would ever approve on the terms this family approves them on. That's the entire advantage. The family already knows the risk. It just needed the paperwork to make that trust enforceable instead of just implied. Let's actually run the numbers, because family bank sounds like a metaphor until you put a spreadsheet next to it, and then it stops being a metaphor entirely. It becomes the single most efficient machine a family can build, more efficient in some ways than the actual banks that turned this into an industry in the first place. Start with the version everyone defaults to. Corinne could have just handed her grandson $340,000. Written the check, watched him buy the house, felt the warm rush of having helped, and moved on. That money is gone, not spent on nothing gone. It bought a real house, but gone from the family's working capital forever. It's now equity sitting in someone else's asset column. If Corinne's family ever needs that capital again, for another grandchild, another emergency, another opportunity, it isn't there. It became a gift, and gifts don't come back. That's not a criticism of gifting. It's just math. A gift is a one-way door. Now we're on the other version, the one Corinne actually signed. Same $340,000, same grandson, same house, except this time it's a loan at 8% over 6 years. Assume it's interest only for simplicity, the way a lot of these family notes are structured to keep monthly payments manageable for the borrower. That's $27,200 a year in interest, every year for 6 years. By the time the note matures, the family hasn't just gotten its $340,000 back. It's collected roughly $163,000 on top of it. The exact same act of helping her grandson buy a house left the family pool bigger than when it started. Not smaller, bigger. That's the entire trick, and it's not even a complicated one once you see it laid out. Here's where it stops being a nice bedtime story about one grandson and starts being a billion-dollar mechanism. That $340,000 doesn't sit still once it's repaid. It gets relent. Maybe to a niece opening a dental practice, maybe to a cousin bridging a business deal, maybe back into another mortgage 2 years later for a different grandchild. Every time it goes out, it comes back bigger. Every time it comes back bigger, the next loan the family can make is bigger too. You're not looking at a static pile of money. You're looking at a pool that regenerates itself, interest payment by interest payment, the same way a bank's deposits regenerate through loans, except every dollar of profit stays inside the family instead of flowing out to shareholders in Charlotte or Delaware. Stretch that out across decades and the numbers get almost uncomfortable to look at. Money compounding at 8% annually doubles roughly every 9 years. That's not a rounding trick. That's just what 8% does if you leave it alone. $1 billion compounding at that rate for 30 years, cycling through loan after loan after loan inside one family, becomes something north of $10 billion. Nobody added new capital. Nobody won a lottery. The family just kept lending its own money to its own people at a real rate and refused to let it sit idle or leak out the door as gifts along the way. But here's the part that actually matters to you, because you're almost certainly not managing $1 billion, and neither is anyone reading this. The math doesn't care about the size of the pool. It cares about the mechanism. A family with $100,000 sitting in a savings account earning 4% at a real bank can instead lend that $100,000 to a family member at 8%, following the exact same AFR rules Corinne's family used, and generate roughly $8,000 a year instead of $4,000, while that money simultaneously helps a relative skip a bank's underwriting department entirely. Relend it over 5 years and you're not looking at $100,000 anymore. You're looking at something closer to $140,000. Still fully intact, still available for the next family member who needs it. Same mechanism at $1 million looks like Corinne's grandson. Same mechanism at $100,000 looks like a used car loan for a kid starting a lawn care business who a bank wouldn't return a phone call for. The zeros change. The math doesn't. Now, none of this works if you only look at the upside, because a family bank carries real risk that a Chase branch simply doesn't have to think about the same way. The first is default. Banks can hand a delinquent account to collections and never see the borrower again at a holiday dinner. Your family can't. If a grandson misses payments, someone still has to sit across from him at Thanksgiving. That's not a hypothetical inconvenience, that's the exact fault line where family banks fall apart if nobody planned for it. The second risk is liquidity. Every dollar sitting inside an active loan is a dollar that isn't available if a real emergency shows up next Tuesday. A family that lends out too much of its pool at once can find itself asset rich and cash poor at exactly the wrong moment. The third risk is quieter and does more damage over time than either of the first two: relationship strain. Money changes the temperature of a room the second repayment becomes a topic instead of an assumption. The sibling who paid on time starts resenting the one who didn't. The parent who lent the money starts feeling like a landlord instead of a grandmother. That tension doesn't show up on any spreadsheet, but it's the reason most informal family lending arrangements quietly implode within a few years. This is exactly why the paperwork from earlier isn't optional bureaucracy. It's the thing standing between a functioning family bank and a family that doesn't speak at holidays anymore. A real repayment schedule agreed to in writing before the money moves does something a handshake can't. It takes the emotion out of the collection conversation. Nobody has to decide, in the moment, whether to bring up a missed payment. The note already decided that months ago in a calmer room, before anyone had a reason to be defensive about it. Disciplined terms protect the borrower too, not just the lender. A grandson who knows exactly what he owes and when isn't left guessing whether grandma's generosity has a shelf life or whether she's quietly resenting him every time she doesn't say so. The structure removes the guesswork on both sides of the table, which is the entire reason it survives longer than good intentions ever do. Get the math right and the discipline right at the same time, and you've built something that outperforms a savings account, outperforms a gift, and outlasts most actual banks. Get either one wrong, and you'll find out exactly where the system breaks, which is precisely where we're headed next. Here's where the story stops being inspiring and starts being a warning, because for every family that builds a machine like Corinne's, there are 10 families who tried to build the same thing and accidentally built a tax liability instead. The line between those two outcomes is thinner than most people think, and almost nobody finds out where it is until they've already crossed it. The first mistake is the one that feels the most natural, which is exactly why it's the most dangerous. It's the handshake loan. Grandpa hands his granddaughter $200,000 for a down payment, they hug it out at the kitchen table, and nobody writes anything down. No note, no interest rate, no repayment schedule, nothing that exists outside of two people's memory of a conversation that happened once over coffee 3 years ago. To the family, that feels like trust. To the IRS, that's not a loan at all. That's a gift, because a loan without paperwork isn't legally distinguishable from a gift that someone's calling a loan after the fact. And gifts have limits. Cross the annual exclusion, which sits around $18,000 per person as of recent years, and you're eating into a lifetime exemption that's worth millions but isn't infinite, and someone eventually has to report it. Skip the paperwork and you haven't avoided the tax question. You've just guaranteed you'll answer it on the government's terms instead of your own, usually years later, usually with penalties attached. The second mistake is quieter and sneaks in even when families think they're doing everything right. They write the note, they set an interest rate, they feel very official about the whole thing, and then they pick a number that feels generous. 2%, 1%, sometimes 0, because it's family. Why would we charge grandma-level interest to our own kid? Here's the problem. The IRS publishes something called the Applicable Federal Rate every single month, the AFR, which is the minimum interest rate the government says a real loan between family members has to charge to count as a real loan at all. Fall below that rate, and the IRS doesn't just shrug. It calculates the difference between what you charged and what the AFR required, and it treats that gap as income the lender should have received and gifted back to the borrower in the same motion. That's imputed interest. You didn't collect the money, but the IRS taxes you like you did, and then treats the amount you didn't collect as a gift on top of it. You can end up owing tax on interest that never touched your bank account, on a loan you thought you were being generous with. Generosity, in this specific case, gets punished twice. The third mistake is the one that undoes everything even when the paperwork looks perfect on its face. You can have the promissory note. You can have the AFR-compliant interest rate. You can have a repayment schedule printed and signed and filed away in a drawer somewhere. And it still won't hold up if nobody ever actually intended to collect. If payments are late every single month and nobody follows up. If the loan quietly gets forgiven the first time the borrower has a rough year, and everyone just moves on without adjusting anything on paper. If the family patriarch says, off the record, at every Thanksgiving, "Oh, we'll never actually make him pay that back." That's not a loan with sloppy execution. That's a gift wearing a loan's clothing, and the IRS has a name for exactly this pattern. They call it a disguised gift, and when they find one, they don't just tax the missed interest. They can reclassify the entire principal as a taxable gift retroactively, which means suddenly the family isn't dealing with a few $1,000s of imputed interest. They're dealing with gift tax exposure on the full amount, sometimes years after the money already changed hands and got spent on a house that's since been resold twice. So let's bring it back to the actual machine for a second, because all three of these mistakes exist specifically to break the thing that makes the family bank work in the first place. The entire point, remember, is that Corinne's $340,000 doesn't leave the family pool the way a gift would. It goes out, it earns 8%, it comes back bigger, and it goes out again. That 8% isn't an arbitrary number pulled out of the air to sound impressive. It sits comfortably above the AFR, which keeps the loan legitimate in the government's eyes, and it sits high enough that the family actually builds wealth instead of just breaking even against inflation. Skip the paperwork, undercut the AFR, or forget to actually collect, and you don't have a family bank anymore. You have a gift that's pretending to be a bank, and pretending doesn't hold up under an audit. And audits do happen, just not on the timeline most families expect. The IRS generally has 3 years from filing to challenge a return under normal circumstances, but that clock doesn't start ticking the way people assume if a gift was never reported in the first place. Undisclosed gifts and misclassified loans can get flagged far later than 3 years down the line, sometimes surfacing during a completely unrelated audit, an estate settlement, or a family dispute that drags the paperwork into daylight for the first time in a decade. By then, the interest and penalties on a $340,000 misclassified loan can dwarf the original $163,000 in interest the family thought they were earning. The exact mechanism built to make a family richer becomes the exact mechanism the IRS uses to claw money back out, plus interest, plus penalties on their schedule instead of yours. That's the expensive mistake hiding inside almost every well-meaning family loan, a handshake deal or an underpriced note that looks harmless for years and then resurfaces as back taxes and penalties nobody budgeted for. If you want to actually build this the right way, the book linked in the description walks through exactly how to structure it so the IRS never gets that opening in the first place.